us on track today. Thank you for joining us today. My name is Valerie Brown with United Policyholders. I'd like to welcome you to our question and answer section today on financial decision making and casualty loss taxes. A little bit about United Policyholders. If you're new to us, we've been helping disaster survivors since 1991. We're a trusted information resource for insurance consumers in all 50 states. We've been in operation for 30 years. We're not for profit, not for sale. We're funded by donations and grants, and we are here to help you. A little bit more about us. We're a very small but mighty professional staff. We partner with governmental agencies and nonprofits across the country. Then we have our volunteers, like our consumer-focused volunteers today, Eileen and John, and also as well as previous catastrophic loss survivors who help with various facets of the programs we do, like speaking and educational events today. California residents, this is your help library for recovery and insurance guidance. And the fine print, this workshop is intended to be general guidance only, not legal advice. We are not creating a professional or client relationship with any individual with today's event. If you need professional help, we please encourage that you seek it. Today's panelists, myself, Eileen Frauberger, she's a certified financial planner and a partner of Abacus Wealth Partners. John Trapani is a CPA who has his firm in Thousand Oaks. Thank you both for joining us today. A little bit about me, a little more about Eileen. I'll linger on that slide just so you can see more about her, and then a little bit about John. And recap, we're going to start with what do you need to know now? So, we recommend that you consider filing an extension before the deadline for your return. It just moved this year. It's now May 17th, 2021. And this is important because you don't know what you don't know. We don't want you to rush to claim things thinking you have a loss because you might have an involuntary gain. And more, we've covered that in detail in the workshop we did on this topic previously. And we'll talk a little bit about the nuances of that a little later in the presentation. Just a reminder that special IRS rules apply. It's only federal DR, federally declared disaster DR designation would qualify for those special rules. And the biggest point to make is that, while we're talking about all things taxes here, you need to just realize that no final decision about rebuilding or replacing should be based solely on those tax considerations. You want to look at your big picture and your overall financial strategies to figure out where you're wanting to go, because you do have options, and taxes are not necessarily a bad thing when you look at the big picture. So we want to make sure that you're aware of that, and you get expert assistance in making these decisions. John and Eileen, just, why filing an extension with the IRS? John, I know you share that the rules are very complex and there's provisions, and then it takes time to know the full extent of your outcomes. And just to allude, I know you've shared that by filing early, you can make mistakes. So could you share one of those stories? Because I think that story drives the point home about it takes several years to know the full extent of those tax implications.
It does. Let's be clear on this. That doesn't mean that you shouldn't file tax returns for several years. You do have a requirement to file tax returns annually, and we can get extensions up through October 15th, but there's still a return that's going to be due for 2020. No later than October 15th of 2020. If your loss was in 2020, you may not have all the facts settled down by that filing date, but you still need to file and basically tell the IRS, the Franchise Tax Board, what you know. It's not a matter of claiming a loss or not claiming a loss or whatever. The first thing is to let them know what's going on, and most likely, if you don't have all the facts, you're not going to be filing for a casual. Even if it's possible in the future, it's determined you still probably don't have enough information, may not have enough information to claim a loss for 2020. And that loss may become if it is a loss, will likely then become a loss in 2021. I think that's probably sufficient for now.
No, thank you, John. And that gets into the tax year to claim a loss. Generally losses can only be deducted in the year in which they occurred. And as John just said, that's not going to be known until your claim is settled. And so this is a little bit of guidance on that.
Well, there is a provision that if you have a loss, then you first determine what year that loss, and the technical word is sustained. And that means that not only has the loss occurred, but all the claims for reimbursement have been settled. That becomes the loss year. And if there's a loss, that would be the year that you would claim it, even though it may not be 2020. But there is an option with some tax analysis and decisions to either claim it in that year or the year immediately preceding that year. So it's not necessarily 2020 and 2019. It might be 2022 and 2021.
Right. And then Eileen, it can also tie into your larger tax strategy with other considerations that you have, correct?
Right. And I think what's important for everyone to keep in mind, this has been a devastating situation. There's no need to rush. And what John is saying is just to take your time, work with your CPA, make sure you give the information that you know up front. And if you need to do the amendment by delaying and saying you'll be doing this later and extending, gives you the time to take care of it, because you're going to need to get all of your documentations to help offset any of the future gains. If there was a gain, what was the basis? What was the repairs? What did you have in the house that now later you're going to be able to offset? So please don't rush. A lot's going on in everyone's worlds right now. Don't rush. You can always amend and you can easily file for an extension.
Thank you. I'm going to touch on this very briefly because we covered this in the full workshop on the disaster taxes. Does your fire have a presidential federal disaster declaration, the DR? On the two links here show you where to get the information. The most important one is that IRS website, making sure that your county, your zip code is considered in that. And the reason it matters is that it listed here are 3 provisions that are available to you. Contents related proceeds are for your primary resident are not subject to taxation. They can be considered when calculating deductions for casualty losses. And then you have some additional time allowances. And as I said earlier, we covered these items in detail in the previous workshop. And Carolyn, if you can make sure that gets out in the chat to everyone, just so they have the link to that last workshop, that would be wonderful. Thank you. I mean, this is a graphic that just shows all the different things involved in getting that disaster declaration, because there are lots of FEMA declarations of disaster, but it's a unique conflux of events that qualify you for this opportunity. And so not every disaster is considered a DR. These are the names of the 2 DRs in California.
Yeah, I just rather than saying not every disaster, but not every catastrophic event is a disaster.
Yes,
But every disaster is a catastrophic event.
Thank you. That's a great way of putting it. All right, John, I'm going to turn this over to you because you explained this so eloquently. If you're underinsured, do I automatically have a loss for tax purposes?
So the issue here is that there are two numbers that we need to start with. And the first number is cost basis, which is basically what you paid for the house, or if you built the house, it cost you to build the house, and any cost that you spent on the lot, plus any improvements that you made to the property up to the date of the fire. Those improvements are, some of them are improvements and some of them are maintenance. But usually if you're spending a substantial amount of money, it's probably an improvement. but there are certain things that that you have to be careful about. So generally speaking, if you've lived in the house for 15 years and you decide to paint it, that's probably maintenance, even though it might cost you several $1,000s to do it. On the other hand, if you put on a new roof, that's considered generally as an improvement, because it's lengthening the life of the structure. Adding a room, putting in a fence, planting major landscaping, trees and shrubs and stuff like that. Petunias, on the other hand, are considered maintenance because they're going to die out every year, and you're going to have to put them in every year. So that's your cost basis. Then we have insurance proceeds, and here you have to be careful that you're only looking at the insurance proceeds related to the real property. So we're not looking at this point, we're not looking at the insurance proceeds for contents or for additional living expense. So basically coverage A and B, but including trees, landscaping, debris removal, and law and ordinance, sometimes called code upgrades. So that gets one number. You got your cost basis. If the insurance proceeds exceed your cost basis, you do not have a loss, you have no possibility of having a loss, because for tax purposes, you've been fully reimbursed your cost basis. On the other hand, if the insurance proceeds are less than the cost basis, then we need to go on and make additional calculations. I think we've got a slide coming up a little bit that we'll step through the basic calculations in the 4684, and I'll go into the other part of the calculations then.
Yeah, no, and we will touch on that very soon. So first question one is legal litigation proceeds. So I was told last year the money I received from the Wildfire Assistance Fund related to the campfire was taxable because the fund was set up by PG&E and PG&E was reporting it. Is that correct?
Not necessarily.
Okay.
Generally, in these situations where there is a third party that is providing financial support to the person who's experienced the disaster, it depends upon what they are paying, and what they are paying depends upon what the plaintiff is asking for. So some of those proceeds may be considered the same as insurance proceeds for real property or for contents, or maybe even additional living expense. Some of those proceeds may be part reimbursement or payment for emotional distress or other non-physical injury claims. I've got one client who made a claim for lost wages and was compensated for that. The lost things like lost wages and non-physical injury, tort damages, emotional distress are taxable proceeds for things like real property. Well, that goes into the overall computation of how the insurance proceeds are treated. So,
Thank you.
okay.
Got one more question on litigation. I had an older mobile home, total loss with no insurance. Replacing it will cost more than 3 times what it cost 32 years ago. So she lists different types of settlements to be taxable. And so the first is home replacement. Would that be taxable?
Well, if let's say that your I don't know, the original cost basis of the mobile home was $40,000, maybe $100,000, and you receive $300,000, which covers the cost of a new mobile home. First of all, if that was your primary residence, you're in from a tax point of view, you're in good shape, because up to $500,000 of that gain being defined as the amount you receive in excess of your cost basis will be tax-free. So it's possible with a mobile home situation that the reporting gets really, really simple.
Okay. And then items in the home Contents, you said would,
Contents totally free,
right, pain and suffering,
taxable.
landscaping.
That's part of the home, so it just goes into the pot with the cost of the home. It does, you don't have to separate funds for landscaping versus funds for the real property. It's all just one big number.
Right, and then related to this, is there a set percentage that might have to be on the one she has to pay? Would there be a breakdown of, by the trust, or, is it does the percentage vary depending on what bucket it's in?
Well, let's first of all say the percent, if it's ordinary income, then it's taxable at ordinary income rates, which would be things like emotional distress. If it's the cost for the residence itself, again, with a mobile home, I would guess and that was your primary residence, I would guess you're probably not going to have any tax to pay at all, unless unless you get like $2 million for the mobile home, then you're not going to spend $2 million for a replacement. Then you might have some tax, and that would be a capital gains rates. But like I said, I would guess with a mobile home situation that it's a question of reporting, but it's probably not going to have any tax consequences other than the emotional distress. In terms of the allocation, that depends on how you structured your claim initially, what you told PG&E, this is what you owe me for these identifiable amounts. And the first thing is you're not going to get a penny more than that. The second thing is you're going to get something substantially less than that. And there's another twist with the PG&E suit that I'm a little hesitant to get into some details, because I think this needs to be resolved really by the IRS. And that's that, generally speaking, when we have these kinds of claims, you're making a claim against an entity that somewhat has deep pockets. Your settlement of the claim is based upon the veracity or the quality of the claim, not the amount of money that's available to pay the claim. So in this case, there may only be money to, even if everybody's claim was determined to be absolutely rock solid, there's maybe only enough money there to pay maybe up to a third of the total of the claims. So this seems to me that it brings in another layer of concern. And I really think somebody needs to do something about getting the IRS involved in the front end. There's like 80,000 litigants here. This is certainly worth them coming in and making some determinations up front rather than dealing with 80,000 audits.
Very good point. Thank you. So FEMA aid and taxes. I understand that assistance for a FEMA declared disaster, no matter the source, is not taxable. If that is true, what should I give my CPA on this topic, basically, so that they handle it appropriately?
Everything. You want to give them information about your cost basis, information about your insurance proceeds, anything having to do with replacements, whether it's rebuilding or buying another property, any costs you spend on replacement contents. And I want to be clear on replacement contents. It doesn't mean that if you had 2 televisions that you have to replace 2 televisions. You don't have to spend any money on new televisions. It's just money that you spend on the type of items that would normally go into a house, into a house. So it would not include a machinist slave, not other stuff, but it's most of the stuff that you would normally find in the house.
Got it. Thank you. This is, John, I'm just going to run through this, nothing to comment on. So which payments may be taxable by the IRS? This is from the previous slide, the presentation. These are the items, so that this, just so you know, this slide deck will be available to you, as well as the recording. So don't worry about writing these down. You'll be able to get this information. These are the payments not considered taxable by the IRS. Just wanted to review this because it's important for people. Next question, tax implications from losing a second home. So I lost a second home in Healdsburg. What are my federal and California tax implications on receipt of insurance proceeds, and how do they differ than if that home were my primary residence? Oops, sorry, jump slides there.
Okay.
For example, are my insurance proceeds from personal property recovery excluded from taxation or included? And then how long do I get to rebuild the house to rebuild a house to defer the gain if I have one?
So unlike the primary residence, any other personal use residence, whether it's a second home, a vacation home, the contents are subject to all of the regular recovery rules. So you do need to report the, and this is where it gets ugly, is the cost basis and the insurance proceeds to determine whether or not you got a gain or a loss. And if you have a gain, then you have the same provisions in terms of reinvesting that you have with the residence, but they're separate from the residence itself. The time period, we hear these words, a 4-year time period and a 2-year time period. Think of this, that there are 2 clocks that are running. First clock started on the date of the event. The fire happened, and that starts a clock. The next clock starts in the calendar year when the total proceeds exceed the cost basis of the property. And if it's a primary residence and the $250,000, $500,000 exclusion applies, then once they exceed that exclusion amount, that determines the beginning of the second clock. And that applies now in the case of a person in a vacation home, second home, you're not going to have that $500,000 exclusion. So it's simply when the insurance proceeds exceed the cost basis. That year, the end of that year starts the second clock, and that then is 2 years for vacation and second homes and 4 years for primary residence. If that is not enough time, and you've made good progress and you've got valid reasons, it is possible to get extensions on a year-by-year basis. They are available, but the IRS only is authorized to issue them 1 year at a time. Last year, I applied for 11 extensions, and within days, I got all 11 approved.
Thank you. So a wrinkle on this, John, what if you had the second home, like that was a rental, if it was not insured, how would that impact the taxes on that?
Well, you said 2 things there. One, it's a rental, okay? So rental is not a second home. Rental
Got it.
is investment property.
Okay,
So no insurance. Well, sounds like you've got a casualty loss, right? Now, if there's 2 things here, is that with the primary residence or even with the second home, the personal use real estate, we combine everything, land, landscaping, building improvements, the building itself. It's all one integral unit, one number. But with rental property, you've got a depreciation schedule that you've been using to depreciate that property on your tax return. And so you have to identify the items that were lost. One thing that's not lost is the land. So the land is not part of the casualty loss. So it becomes now the building, presumably the landscaping is also destroyed. So any landscaping that you're carrying as a separate asset, then that becomes the basis for determining the loss. Now, if it's rental property and you've been depreciating it and everything is lost, then it makes it a little simpler in terms of determining your loss. You don't need to actually get appraisals of the fair market value before and after. Your loss is simply the adjusted basis of those properties, of that property at the date of the fire.
thank you.
Val,
Cost
can I
rate-
chime in just
Yeah.
for a sec? I
Yeah,
just want to point out, I see that there are quite a few individualized questions that are still coming into the Q&A. And I just want to encourage everyone to, these questions, Val, if you want to just better overview, came from other questions, previous questions. just so everyone knows that we're going through this to give a scope to best help us answer, and the customizable Q&As that are coming in now, we're trying to incorporate as we respond.
Thank you. Yeah, thank you for clarifying that, because this is our normal Q&A format where you're requested to submit questions in advance so that we can build the slides and prep our experts to answer the questions. So as Eileen said, if I can weave in your question here into the topic we're already discussing, I will do so. And if we have time at the end, I will work as many of them as we can. So question 5 is cost basis. I know several people actually have this in the Q&A right now. So I thought I understood that determining the cost basis with the purchase price, including the cost of the land. Is that correct? Oh, sorry, there we go. Including the cost of the land, even though I still own the land. And then if I spend a portion of my insurance proceeds on a replacement home, but with a lower cost home, do I subtract the replacement cost I paid, including landscaping, from my insurance gain before calculating capital gains to be taxed? That's a lot, John. Sorry.
That's a lot. Okay, so first of all, in terms of the cost basis of again, we're looking at personal use real estate. It includes the land, it includes the house, it includes the addition, the improvements, the rose bushes, the fencing, the swimming pool, everything. And yes, even though you still have the land afterwards, all of it, the land cost and all of it is considered one single number that becomes your cost basis for determining a gain or a loss. Then if you've lived in the house sufficient time and the house was totally destroyed, in your married couple, you get a $500,000 of gain as represented by insurance proceeds in excess of that cost basis. The first $500,000 of gain just is gone. No worry. I mean, it needs to be reported and shown, but basically that's just, it's off the books. It's gone. So if you had a $300,000 cost basis of the real property and you got $1.5 million in proceeds and you live there long enough, 500,000 would be taken away, leaving $1 million of proceeds, $300,000 costs. We've got a $700,000 gain. If you go out and buy a replacement property for $1 million, then you've satisfied the replacement requirements, and that $700,000 gain gets deferred against the new property. So what happens is the new property that you acquired for $1 million, reduce it by $700,000 deferred gain, and that cost basis going forward then is $300,000. It's never a forgiveness of the gain, it's just a deferral. If you live there long enough, it might get inherited by a relative, child or something like that, and then it escapes altogether. But if you sell it later, then you've got to deal with the potential gain again. But again, if you've lived there long enough, again, you're going to be able to get another $500,000 exclusion.
A wrinkle on cost basis, John. What if you paid more to replace the home than you received from insurance? Does that help or hurt?
Well, that will create new cost basis. So given my example, let's say that you don't buy a house for $1 million. You buy a house, you got $1 million. First of all, you got $1.5 million in proceeds, and but we got to exclude 500,000. But you spend the whole $1.5 million on a new house. Well, you're going to again take that $700,000 deferred gain and offset it against the $1.5 million, and you'll have a cost basis going forward of $800,000. If you spend another $300,000, well, that's another $300,000 that'll get added to the cost basis.
All right, and so related to this cost basis, like to calculate your cost basis, like if you rehabbed a badly broken home, all your receipts were lost in the fire. How do you estimate that, and what will the IRS accept? I mean, it's hard to pull that together from memory.
Uh, it is, and and fires I think are very difficult. My house was severely damaged in the Northridge earthquake, and so I still had physically the structure intact, so to speak. And I remember, I hate to admit it, but I was not a real good record keeper in terms of my improvements to the house that we had lived in for 18 years. And I spent days just sitting in a room or sitting in the yard and just thinking, okay, what's here that wasn't here when we moved in? What did we do to this this room, or what did we, oh yeah, there's a new roof that we put on. So you may need to do the same kind of thing, not worrying so much about the cost to start off with, just making a list of what the items were, and maybe husband and wife and family getting together and just talking it through, and talking about the house that was burned. And I understand it probably is going to be a gut-wrenching thing to do, to deal with the memories and stuff like that. But that's kind of where I would start, and then start assigning, well, geez, okay, well, we remodeled the kitchen. How much did we spend? Well, yeah, you're not going to have every invoice or every receipt in normal circumstances. And given the situation, yeah, a lot of that stuff probably burned up and it's gone. So, you make your best estimates, and you're reasonable. If you live in a $500,000 house, you're not likely to have a $200,000 kitchen remodel. If you live in a $3 million house, you might have a $200,000 kitchen remodel. So it's kind of like making sense of what you've got and being reasonable about these things. Mostly being reasonable. And there's actually a very old tax court case that involves George M. Cohan, which you may remember as the song and dance man from the 30s, 40s, and 50s. He had a manager that stole from him, and all the records were gone. And the court basically came up and said, well, geez, we know that you appeared in Poughkeepsie, New York, and that you would have stayed there and you would have had these expenses. And so they basically came up with the Cohan Rule, which basically was what's reasonable in the circumstances. It's not necessarily capturing every possible cost that he actually incurred, but it's giving a decent shot at what's happening. So, if you end up in audit and the IRS is questioning your $50,000 kitchen, then you might think about the Cohan Rule.
And a related question about this, are there other ways to establish the loss rather than a before fire, after fire appraisal? I guess this is for a partial.
Well, I mean, there's things that people will do, and I can't, but in terms of looking at the fair market value before and after, what the Internal Revenue Code requires is appraisals by qualified appraisers, not a real estate agent, not the county assessor. We can go through all kinds of, definitely not a claims adjuster or a public adjuster. It is a qualified appraiser, and that appraiser needs to include in his reports certain things that are in addition to the normal things that he would include in his report. One, there's some calculations, and two, there's just some disclosures, basically, that he understands that his report is going to be part of a tax filing.
Got it. Okay. And then one little wrinkle here. So cost basis can include county building permits, survey, the geological testing, soils, architect's fees, all of that stuff.
Absolutely. Both on the original house, if you built the house yourself, and on the replacement, all those costs, the architectural fees, the engineering. Yes, these are expenses that you would not be incurring were you not building the house.
Got it. Thank you. All right, let me go to the this was just a slide that broke that down into questions. So actually, I know we had a question about this. So John, this is that form 4684, line 5, fair market value before casualty or loss or theft, sorry.
Yeah, so well, above there we had what a cost basis of 400 and some odd thousand and insurance proceeds of 103,000. So
Yeah.
starting there, we've got a pretty good idea. The house is gone. It's probably a pretty good chance that there's a casualty loss here. So it's worth taking the next step. So we go out and we get the appraisals, and the appraisal comes in that says that the value was 775,000 before the fire. Now, what does that appraisal look like? Well, theoretically, it looks like an appraisal that would have been received if you were selling the house. Okay. Obviously, the problem here is that the appraiser is making an appraisal of an asset that no longer exists. So any pictures or documentation that you have is useful. If you refinance the house within the last couple of years, there was an appraisal there. That appraisal won't be valid, but the appraiser at least has documentation about what the house looked like prior to the fire. Now, the purpose of that appraisal might be to get a loan so that you can add on a second story. So obviously the appraiser doesn't have that information, but you can get plans and things from the county still that are useful to the appraiser to say, oh, okay, that added X amount to the values. So that gets us our value before. In this case, the value after 100,000, maybe that's the value of the lot, but there's a couple of wrinkles here. One, the value after is literally the value immediately after the event. And the importance of that is that we know two things about that value, or that lot. One is that it is burdened with a lot of debris. There's all the ashes, the burnt trees, all this stuff that needs to be removed. That is going to reduce the cost base. That's going to, excuse me, not the cost base. That's going to reduce the value of that land that other than what it would normally be. The other thing that happens in these cases is that the IRS says that there's a high probability that in these cases where there's widespread devastation, that values in and of themselves are depressed. And therefore, there's something called temporary buyer resistance. And the IRS says that is not part of the casualty loss. And that basically has to be removed. So the value, forgetting the debris here, these people might be able to sell this lot for, maybe $60,000. But the value that there's a $40,000 discount because of temporary buyer resistance. And so that has to be added back to get to the 100,000. One of the ways that you might look at the temporary buyer resistance is imagine that there is a lot just outside of the fire zone, but adjacent to the fire zone that was untouched, and it's sold after the fire. And you find out that in fact that lot sold at a discount from what it previously was worth. Well, that might be a good indication of the amount of the temporary buyer resistance. But these are things that the appraisers who know what they're doing in this area should be able to do. This is their job. This is their expertise.
Well, this goes back to what John and Eileen have both said. It's take your time, get your information, get professional help where you need it, and because it's complicated.
Now, let me finish the calculations here. So we have the 775 versus the 100,000. So the decrease in the fair market value is $675,000 on this page. We can never deduct more than the cost basis. So the loss is the lesser of the decrease in fair market value or the cost basis. In this case, the cost basis is less than the decrease in fair market value. So that becomes our limit. And then from that, we deduct the insurance proceeds to come up with the $318,000 actual casualty loss.
Thank you. All right, and so we've actually answered this one about cost basis. Question 7, paying off the mortgage. Our insurance originally paid us the full policy amount for the dwelling. We were planning to rebuild. The insurance check payment was made out of both of us and the mortgage company. So Eileen, this one's for you. Do I need to pay off the mortgage? And I know other people have asked that question too. So a little nuance here.
Right. I think this is a really difficult question because the mortgage company will always want you to pay off the mortgage in full. They just want to be done. And I'm always going to say this is truly a moment to sit back and say it's a liquidity question for yourself. If all of these proceeds go directly back to your mortgage, what happens for the future new purchase? What happens if you didn't have enough insurance under the replacement of contents? You're allowed to use all of your buckets for your future life. So I want to caution everyone, I would not immediately assume that you want to pay your mortgage off in full while you're in the process of making much larger, bigger picture decisions.
I would just add a little bit of a twist, which is a tax twist, and that's the fact that the money went from the insurance company to your hands long enough for you to endorse the check, and then went to the mortgage company. For tax purposes, that money is treated as having been received by you. So it's if you end up getting that money back from the mortgage company 3 years later, it's not proceeds that you received 3 years later. You received it today when the check went to the mortgage company.
And I think on that, John, I think we should all clarify this a bit, because the real question is if it's also paid to the mortgage company. You know, that does put this slight twist to all of this, whether or not you have to leave it there. I just encourage everyone to look at your options and not immediately say it has to pay off my mortgage in full, because I think too often it could lend itself to a liquidity issue.
Well, yeah, the unfortunate thing is a lot of times the mortgage, you haven't paid off the mortgage, so you still have to make those monthly mortgage payments, and you're still getting charged interest on that mortgage. But a lot of times the mortgage company holding those funds, they don't even pay you interest for that.
Yeah, well, and that's a different issue because California, the law says they will, but it ends up being a debate, an issue of the debate. Related question on this topic. So the mortgage company is retaining 94% of the settlement until construction begins. The value of the land is more than the loan balance. Can they do anything about that?
I would say that's a question of negotiation with the mortgage company.
Right, so that they're only retaining what they need to. Because I know that was a question that came in at the last minute to email, was the fact that the mortgage company is very slow on the payment, which is what I think a lot of people see. That they have, that it getting debris and your foundation work and your site work and that stuff, that work done, and not having that promptly paid. And so any words of wisdom on that piece?
Yeah, I think, again, these are situations where you have to really look at where else could you get additional funds for in the short term. I'm never an advocate of taking loans from retirement accounts or things like that. But if it's a short-term enough issue, it's possible these are times that you do look for how else can you find some liquidity on a short-term basis. The mortgage payments alone, if they're doable and you don't have to pay something off directly, you might have an opportunity to float a little cash depending on the buckets and depending on where funds are coming in from. Again, it's a tread carefully, move slowly, but look at what other options might be available.
Yeah, and a lot of people will use their contents and move it over temporarily just to get cash flow going. Next question, question 8, interest on capital gain. Are the insurance gains charged 3% interest per year? If I don't pay the capital gain in the year I receive the payment. My insurance was very efficient and paid me the full amount in 2020, yet I'm spending funds now in 2021, recovering my land and putting a tiny home on the land. I don't want to be charged 3% interest, would plan on paying, on estimating what replacement costs will be this year, subtracting them from the insurance proceeds and then paying the gain.
Well, this gets into planning out how much of the proceeds are you actually going to reinvest, and then determining, okay, that leaves the the amount in excess of that that is not going to get reinvested in the real property, and therefore there will be taxes due on that. Now, they become taxable in the year that you receive them, and if you make the election to just pay the tax, then you've avoided that IRS interest. And on the other hand, if later you determine, oh, you know what, I was going to buy it, I was going to do the tiny home, but you know what, I determined I'm going to do a bigger tiny home, and I need 100. I want to get 100. I'm actually going to spend $100,000 of money that I didn't anticipate. Well, you can go back and amend the return and get the tax back on that $100,000. Unfortunately, the IRS doesn't pay interest in that case. But if you have a gain that ultimately becomes taxable in, say, 2021, and you don't determine that how much that gain is until, say, 2023, well, it's still going to be taxable in 2021, and you will have to file an amended return for 2021, pay the tax. The IRS will charge you interest, but hopefully not necessarily guaranteed. They won't charge you penalty for underpayment of tax.
Thank you. It's question 9, when to file form 4684. Who's required to file it? I'm certain I don't have a tax deductible loss. My coverage is adequate. I'm also using all of my insurance proceeds to rebuild. Do I need to file the form? And do insurers send out 1099s reporting settlement payments to the IRS?
No 1099s. And if you don't have a loss, then you don't file form 4684. And I've seen tax returns where the tax professional just doesn't understand what's going on, and the IRS only has one form, and it's that 4684, but it didn't apply because there was not there was not a casualty loss, and any gain is going to be deferred. That does not get reported on 4684. It gets reported on, according to the IRS in their publication 547, it gets it reported in a statement attached to the tax return explaining all the facts and circumstances, and the list is about 15 items long.
Thank you. Question 10, extensions and landscaping. So we received the maximum for landscaping, not yet replaced it. Do we file for an extension to cover the time it takes to do the work so we don't have to pay taxes on the money? How long an extension can we request if our loss was landscaping and other structures, not our residence?
Well, if your loss was only the landscaping, again, the cost basis that you're going to be comparing the proceeds for the landscaping is the cost basis for the whole property, the house, the land, the structure, everything. So it's very possible that you're not going to have, it's probable that you're not going to have a gain. And it's actually, in that case, it may actually be possible that you have a loss. I've had a client that had literally a house and garden landscaping, and of course that she got insurance proceeds based upon 5% or whatever it is for landscaping that's built into her homeowner's policy, but her loss was like 4 times that amount based upon an appraisal of the value of her house before and after, the whole property before and after. And we actually were able to claim a substantial casualty loss on that situation.
All right, and then I've got a related question, sort of related, so not about the extensions, but uninsured Iris farm, the irises were complete loss, tractor, farm equipment, and not insured, so they could write that off as a loss, right? But that gets into that appraisal piece that you're talking about.
Yeah, and in that case, I mean, you're not going to need an appraisal because you're talking about a business asset and you've been depreciating it. It's whatever cost basis is left at the time of the fire. That's just a loss. A lot of times on property and equipment, uh, for tax purposes, there's been a lot of depreciation, and the actual cost basis for tax purposes may actually be zero. So you could be in a position, if it's uninsured, you don't have a loss because there's no cost basis left to claim.
Got it. Thank you. All right, deep breath for everyone, including definitely me, definitely John. And as Eileen mentioned earlier, we're trying to weave questions into the chat as we're going, but we're also trying to keep this timely. So last deep breath, we're going to keep moving. Question 11, losses for additional landscaping. Actually, John, you've covered this, so we can skip that one. Timber losses. This is where we get into tricky things. So my 20 acres is zoned timber production. In the 40 years I owned it, the value had increased for the trees for lumber. Sorry, let me go back here. But now they're all burned. My homeowner's insurance will not cover the timber loss. Is there any way I can recover this in taxes?
Well, again, this becomes a question of the value of the property before and the value of the property after. And so it's not necessarily the value of the trees, it's the value of the property, which includes the trees. So, I've got a, in front of my homeowners, my townhouse community, we've got a very old oak tree. It's one of the 3 oldest oak trees in Thousand Oaks. How much is it worth? I don't know. It might be worth $1 million, but if it wasn't there, would the value of the property go down $1 million? Maybe not. Maybe might only go down $100,000. So it's appraised value before and after, and then compared to the cost basis.
All right. And then what about the costs to remove trees post fire? Can you throw that into the cost basis?
No, that what happens after the fire does not affect the cost basis before the fire. That is new cost basis that is getting added to the value of now the land.
Got it. Thank you for talking about that differentiation. All right, Prop 19. So obviously November 2020, state of California voters passed Prop 19, providing a tax savings for those who lost their homes in wildfires. The question is this proposition proactive to Paradise, the 2018 fire? And the question is driven because a lot of the pro ads were featuring people from Paradise as a way to get people to pass it. So I know we've reached out to get that answer. John, have you heard anything about whether it's
I have not heard whether or not it would apply based upon when you had the loss or versus when you acquired the replacement property. So if you acquired the replacement property after the effective date of Prop 19, then that'd be a separate issue. Keep in mind that even before Prop 19, there was a provision that allowed you to do this. The only the major difference is that prior to Prop 19, there were only, I think, 11 counties that you could move to from the county that you were in, that you could move your property tax base. But now you can move to any county. So that's the major difference. And if you're staying in the county that you were originally in, so if you buy another property in Paradise that didn't burn down, well, then it doesn't make any difference whether or not Prop 19 is in effect or not, because you can use the pre-Prop 19 rules.
Thank you. 14, what about construction loans? Eileen, I know I mentioned this to you earlier today. So I'll let you read the question because I know you can see it and everybody's got it. And if you can just address.
I think, again, it comes down to everyone's timing. If you're able to qualify for a construction loan and you're comfortable using this as a bridge, it could make a lot of sense for people. it's really a question of what's available. What are the terms? How quickly will you have other monies to put towards this? And again, I hate to keep using the word float, but it's a question of when are you getting other proceeds to pay this off? And are you comfortable with the amounts that are coming in? But I think in a lot of cases, this could make sense if someone's able to qualify.
Right. And the question on the screen is someone who had paid off their mortgage and now they can't qualify before they, and so they can't qualify for because they're saying you have to qualify for the full house cost minus the balance of the funds left. So, and because it took most of the funds to pay off the mortgage, the insurance company is not going to give them their extended coverage till they expend what's received. And so are there other ways besides the construction loan to look at that, to pull that money, the funds needed to do that?
Well, and I'm sorry, I misread that as far as assuming it was a question of should someone use a construction loan? I think you have to go back to, and I guess on Val on this, I might actually even toss it back to you. Are there any other type of FEMA loans that are available? Is there any other access to funds? And to me, this is the liquidity question. If you've already used the monies to pay back a mortgage and you no longer can qualify for something, again, this may be the time that you're looking at a retirement account, that you might be taking a loan against something that you already own yourself and repaying it. I don't usually recommend that, but in certain cases, it may make sense to look for funds in other places. And I'm really going to stress though, because I think this comes up a little too frequently, under the bigger picture, what is the cost of what you're now rebuilding? And should it be at this price versus maybe looking at the big picture of what could be more affordable for the future? So just because there's a blueprint that says this is what we need to rebuild and this will be the cost, does it make sense if you don't have the funds from other sources to be able to do what you're trying to accomplish?
Actually, thank you for pointing that out. So two things on this. One is if you you had applied for FEMA, were denied, they should have booted you over to SBA, and that loan at 2% is a great option until you can make other arrangements. A lot of people do that as a bridge, and then they refinance later. But we had a call with Fannie Mae executives yesterday. And they, they own a sizable portion of the mortgage market in the nation, and they did one of the things they threw out for this is that you can talk to your mortgage company about negotiating what it is that you're rebuilding. For those of you who still have a mortgage, right? And you can downsize it, right size it. As long as you have the conversation with them and they agree to what you're proposing, you can make changes. It doesn't have to be that 5-bedroom, 3-bath house that you had before. It could be a different footprint, a different size, but you have to have those conversations before you start rebuilding so that you've got their permission, because they do have a vested interest in you rebuilding that property. But for this question specifically, definitely look at SBA as an option if you're able to apply for that. And if you're in your community, if you have disaster case managers, that is another option to talk about, because you don't have a mortgage for this person specifically. Since you don't have a mortgage, you can rebuild what you can afford, right? So if you don't need to replace that house at the size and footprint you had, you can build smaller. A lot of people in this situation will do an ADU, so an accessory dwelling unit, and then they build that because that's what they can afford. And while they figure out that long-term financial future path, they'll end up turning that into a rental when they rebuild the house as they've worked out that plan. So if that land is where you want to be, then that is another option to consider. And I think both John and Eileen mentioned earlier, if this is not where you plan to be, perhaps you're looking at that big picture. If you're looking at in 5 years, I want to move closer to my kids, then, is it time to accelerate that plan, looking at the assets you have and potentially selling the land? So just wanted to throw that out there. Let me jump to our next question. I know this was popping up in the chat. So this is about selling the lot. So John, the question is, what if I sell my lot 2 years after the fire? Can I still use my exclusion? Will my proceeds be taxable? This is a family that's underinsured and have received insurance proceeds that exceed their cost basis. So they have an involuntary gain. And they're looking at paying the capital gains tax using Schedule D for the structure.
Okay, so several pieces here. First, let's look at the sale of the lot as on its own merit. So sell the lot as you can take those proceeds and treat that as part of the overall proceeds and basically add it to the insurance proceeds that you've already received. Additionally, when at that point, basically your cost basis on that lot, because we're already in an involuntary conversion situation, your cost basis on that lot is 0. But after the date of the fire, maybe you've spent $50,000 in debris removal. Well, that along with the closing costs and the commissions becomes an offset against the land sale, reducing the net land sale. Now, let's look at the section 121 exclusion. Let's say up to that point, you've used $300,000 of your section 121 exclusion, and you sell the lot for $200,000. Well, if you sell the lot within 2 years of the date of the fire, so it goes back to the date of the fire. If you sell the lot within 2 years of that date, then not only are you including the proceeds, no matter what, as part of additional proceeds, but then you can also use any unused remaining section 121 exclusion. But if you wait 1 day past that 2-year mark, then you can still include the proceeds as part of your overall proceeds for deferral, but you can't claim the 121 exclusion on any gain there. So very, very a lot of careful planning, and I've seen people miss that by a couple of days. Sometimes it doesn't make any difference if you've used all of your 121 exclusion, then it doesn't matter on that basis. So.
Got it. Thank you. I'm looking to see if I had any other. Let's see. Tax implications of later sale of land after home destroyed and insurance reimbursed A and B. And I think you've covered that. So let me go ahead and check that off. And I think that was the last of those. And then this is the information from our previous presentation about this. So just wanted to share that with people. So selling, if we decided to sell the land, do we have 3 years from the date of the fire in terms of capital gain? It was our primary residence.
What you have is the replacement period. So if the fire is in 2020 and you first realized a gain after offsetting the 121 exclusion in 2021, then you have until 2025, 4 years after 2021, to replace the property. If you sell the land anytime up to that point, then you can include those proceeds in the overall transaction, just like they were other insurance proceeds. If you again wait until after the close of the replacement period, then that's going to be a separate sale, and your cost basis on that is probably going to just be the debris removal that you've invested in that land.
Got it. And Angela, this answers your question about the tax exclusions. How long do you have, John? It's just that slide with the 2 years and the 4 years about the replacement period.
Right. And again, it's not 2 years or 4 years after the fire. It's 2 years after the end of the first year in which you first realize a gain, and that gain is again, determined after taking any 500, the full $500,000 exclusion if you're entitled to it.
Got it. Let me see if I can move our heads here. Sorry. My controls are kind of all over the place here. Question 17, selling the land because we can't afford to rebuild. So what are the tax applications if we have to sell our property because we don't have enough funds to rebuild? Do we have to pay capital gains tax on the land sale, or can they roll the funds from the purchase of a replacement home? And then what happens if the wildfire loss, the insurance payouts, and the land sale all happen in different tax years?
Well, again, the land sale is, think of that as just another bit of proceeds, just like any other insurance proceeds. So it's year by year accumulation. So again, you may not have a gain. You may have a situation where the insurance proceeds are not sufficient, and within that, and within 2 years of the fire, you sell the land, and now all of a sudden you got a gain. Well, now you can use your $500,000 exclusion, and you still don't have a gain yet. And so that 4-year the end of that 4-year replacement period has not been determined because you don't have a gain yet. So a lot of number crunching is all I can say.
Thank you. Partial losses. So what about taxes and partial loss? Can you please address how tax issues might differ for a partial loss versus total? So major damage to outbuilding, a guest home, other structures, but the home's intact. And then the other part is compromise property value if not rebuilding that structure, but just repairing.
So, well, the first thing is because the residence itself has not been destroyed, the $500,000 exclusion is not available. But so we've got the outbuilding, the guest house. If the proceeds were reasonable, were fair, and it's very possible that they may still be less than the cost basis. So you may not, you may or may not have you probably don't have an involuntary conversion gain. Then the question is, do you have a casualty loss? So now you look and say, geez, using the prior numbers that we were talking about before, $440,000, $41,000 of cost basis, $103,000 now. Let's say that was for the coverage for the guest house. How much did the property decrease in value? It probably didn't go from 775 down to 100, but maybe it went from 775 down to 575. So now you've got a $200,000 decrease. So now you have a potential loss of 200,000. It's less than your cost basis. So that would be the limit of your loss. And now you deduct the $100,000 for the insurance proceeds, 103,000 for the insurance proceeds, and you've got a $97,000 casualty loss. In other cases, maybe the decrease in the value of the property was only $100,000. Well, you received 103,000 insurance proceeds, so you don't have a loss, and you don't have a gain.
Got it. The next one, contents. Contents loss. If an insurance company estimates their contents loss above the limits of our policy, is that a potential tax write-off? Does cost basis apply in this case?
The answer is yes, maybe, and yes. Okay, so contents are tricky, and there's different kinds of contents. I mean, for instance, if you had a couch, let's say that you paid $2,500 for several years ago, the replacement cost on that couch might be $4,000. Did you get $4,000 for the couch? Well, if you if in total your total claim for reimbursement for contents was your claim was $500,000 and you only got $400,000, well, did you get the couch reimbursed or something else, or did you get a pro rata of the couch? Now you've got to look and look at all of the items that you've claimed, and then determine your cost basis. But then not only determine your cost basis, but determine the fair market value. Now you're not going to get an appraisal on the couch, and in fact, unless the item has a value at the time of the fire of more than $5,000, I wouldn't worry about getting appraisals. You use your best estimate, but it's going to take a long time to do that. There is an alternative that the IRS put out there at the beginning of 2018, which basically you would take the replacement value of the couch, that $4,000 my example, and for every year that you owned it, you would depreciate it 10% up to 9 years. Then after that, it's just 10. It stays at 10%. And so if you own that couch for 3 years, so that would be $1,200 for $400 a year for 3 years would be $1,200. $1,200 deducted from the 4,000 would be 2,800, and that would be your cost basis for determining, and your fair market value for determining whether or not you have a gain or a loss. And you do that for all of your assets, and then you compare that to the insurance proceeds, and then you have a gain, or you might have a loss. An interesting point here is that when you're considering replacement value, you go and you go online and you look, oh geez, there's my couch, it's identical to the couch that I lost, and it's now costing $4,000. Don't forget to add the sales tax and any, if applicable, any delivery charges to come up with your replacement value.
So, John, just to piggyback on, so this is contents, right? And then we had a question in the chat about the landscaping, retaining walls, well water, plumbing, ALE loss, smoke damage, irrigation damage, all of that stuff. How does, the cost basis of that kind of thing feed in?
Well, let's put the ALE aside for a second. So again, if this is your primary residence, remember we have one cost basis for everything: the landscaping, the fences, the swimming pool, the gazebo, whatever. It's all just one single number. So the proceeds for the insurance, if I presume you're talking about, well, this could be the landscaping portion of, and generally the landscaping is like 5 or 10% of the schedule, the coverage A. It may not be enough in some cases. In some cases, it may be okay. But you're looking at the total cost and the total, you're looking at totals. You're not isolating individual items, and the proceeds for the landscaping get lumped in. The IRS doesn't care whether it's landscaping or building. It's all real estate. The ALE, this is, do we have another question on ALE?
I don't think we do today. We
Okay,
did yesterday.
Okay, so let me talk about that a little bit here. So what happens with ALE is this is for compensation of expenses incurred after the disaster event, and the IRS position is that any expenses, any ALE proceeds are not part of the disaster itself. They are separate. Okay, they're obviously integral in terms of the reporting, but they are not part. So the costs of a hotel don't get added to any casualty loss in any way. So the casualty, or excuse me, the costs actually incurred for additional living expense, which might be hotel costs, eating out because the hotel doesn't have a kitchen, any of those expenses, you tally up on a cumulative basis against the, and maybe you're renting a house, you add all that stuff up and compare that to the total ALE proceeds that are received up to the time that you actually move into a real piece of real property that you either own, or maybe you decide you're not going to own anything and you're just going to move into another apartment on a permanent basis. So you've landed, then at that point you tally up, and if there's expenses in excess of the proceeds that you received, those are not deductible. If there's proceeds that you received in excess of what you spent, then they become taxable in the year that you no longer incur additional living expense. Val, is there a question? I can't remember. Is there a question on temporary purchases of temporary homes?
We had one that popped up in the chat, but before we let contents go, just one of the questions came up about how do you document it? Because, you know, the insurance companies might require you to list every single item. Some allow you to group it. Does the IRS care?
Well, yeah, the answer is yes, and I've seen lists as long as 12,000 lines. Yeah, if you're looking to get a casualty loss claim out of it, yeah, they want you to go through and do that. Now, I have to say that the list that was 12,000 items that I saw, one of them was prepared by a public adjuster. So they're sifting through a lot of information. So they might find a teacup here and then another teacup here and then a third teacup. So they've got 3 line items. Well, you're going to basically say, oh, that's from that set of dishes, and that was a service for 12. And here's the replacement cost for that service for 12, which might be, you know, 125 individual items, but it's the service of 12 of such and such a type of china, whatever that you'd be listing and dealing with for the tax on the tax side.
Thank you. All right, let John take a deep breath here. We're gonna hit business and cost basis, and I'm gonna weave in a couple more of these odd questions we've received.
You said you did have a question on purchasing temporary housing.
Yeah. We'll run through these and we can pop that in at the end. Yeah.
Okay.
So question 20, home office business losses. So our home office business loss is a business loss. And where can I deposit building funds to avoid the 2-year rebuilding window?
Yeah, this is tough because in effect you've got 2 separate transactions. I mean, it might be your 3rd bedroom in your house that you've converted and used solely as an office, and you're depreciating it and all that. But for tax purposes, you've got 2 separate losses. Now, the tough part there is that the insurance basically covered you for your house and didn't separate out the business asset versus the rest of the house. You might have I used to have a home office, and the insurance company I had a policy for business pursuits in the home with that insurance company, and then I changed insurance companies, and they said no, we have to have a totally separate insurance policy. So you have to look to see what your insurance coverage is, but you probably have, and I've got a few of these where it's basically 2 separate reportings. And yeah, you have a situation where you've got a 4-year replacement window on the house, and yet on the business property you've only got a 2-year replacement window. And you know, and you may in certain circumstances need to get an extension of time because geez, the house hasn't been built, so my home office has not been rebuilt yet. And so asking for an extension on the business side.
Right. And would rental properties count on the business side under that 2 years?
Yes.
Okay.
Anything that's anything that is not a primary residence basically has that 2-year window as opposed to the 4-year window.
Right. And so you can ask for extensions, but at some point, do those gains become taxable if you don't put them back into that replacement property for the rental?
Well, if it turns out that if you have not reinvested yes, they become taxable, but they become taxable in the year that you in the year that you realize the gain on that piece of the proceeds. So that may have been 2 years ago, and you've got to go back and amend that return to report the gain that you did not reinvest.
Well, and with rental income, what about loss of rental income? So you lose the rental. How long could they claim that loss until they
Well,
replace?
there's no loss for loss of rents. It's just you did not receive the rent.
Got
You
it.
know, you pay tax on the rents you receive. If you don't receive the rents, then you don't have income to pay taxes on.
Got it. And then one more, make sure that, so had a business vineyard on the property. Some of the losses were covered by insurance and paid for. So what happens with those funds, and what do we do about the remainder of the losses that weren't covered?
Well, I've got a couple of situations with ranch assets where there's real property, there's structures, there's equipment, and there's whether it's vineyards or trees or whatever. And generally, those, one case that is insured, but generally find that that stuff doesn't get insured. So you might have a casualty loss claim on the trees, but again, you're looking at the trees, maybe the irrigation system, but not the land. And then you've got the maybe the manager's house or something like that, and that's insured. So you've got a separate calculation dealing with the gain or loss on that structure. And then again, the equipment, and most likely the equipment has probably been totally depreciated. So any proceeds there will be a gain. And so now you need to you have to look to spend money on replacement equipment using the funds that you received from the insurance for equipment. And you may end up spending more than what you received from the insurance, but those have got to be isolated into those 3 different buckets.
Got it. Thank you. All right. The last question I had in the deck was determining the value of the loss. So, and I think you've already covered this, but how do you get to that after fire value of your total loss when there are no other listed sold parcels to assess value with? Just again, what are the options for that?
Well, that's why appraisers have their profession. So
Enough, right? And let me jump. I had some slides built in here in the end about qualified casualty loss, and I just wanted to call out, it's very rare to have one. Other provisions of disaster tax law can be an assistant in reducing potential tax burden. Just that's good news. John, I've got that on the screen, the red version of the flow chart that runs through that, but I want to hold on that and see if we can get this ALE question. I'm in a temporary home post 2018 Camp Fire federal disaster. I got 2 years of ALE and took out a mortgage. Is that taxable?
is the mortgage taxable?
Yeah,
No, because that's money you have to pay back.
right. But so she bought a temporary house with her ALE proceeds. So
She bought
yeah.
a temporary house with it. Okay.
Yeah.
So this is a
Not a
class,
mortgage.
this is a
Yeah.
classic question. So I'll use some numbers. So let's say that after the fire, you settle with your insurance company and you got $150,000 of lump sum for ALE. And so some of that went into maybe some hotel and eating costs. And so maybe you ate up out of that 150,000, maybe let's say $10,000. So you got $140,000 left, and you use the sum or all of that as a down payment on a temporary home. Well, the IRS's position on that is you're no longer incurring additional living expense because you have now acquired a capital asset. You've landed. It may not be your permanent house, but you've landed in a property that you actually own. So you're not you're not incurring additional living expenses. So whatever's left over becomes taxable at that point. Going back to the 17 fire, I was not involved with the client until later in the summer of 18. But the client did, I think, got some, I think, I'm not sure if I remember right. Let's say it was $150,000. And the fire was in October, and in November, they went out and they bought a house. But they did not move into it. They were still living in the hotel. And they were doing work on the house to make improvements so that they could move in. And they moved in January of 18. So all of their hotel expenses up to January of 18 get charged against that ALE, but whatever's left over, even though they spent it on purchasing that house, that became taxable in 2018 when they moved into the house, not when they bought it, but when they actually moved into the house. So that was quite a surprise for them. Now, in a lot of these cases, what ends up happening is people use that house for a couple of years. And it usually takes more than a couple of years, and then they sell it. So a couple of things happened here. One, that house can be treated as part of the replacement property, so some of any deferred gain can be allocated to that house. So it reduces the cost basis, but you've lived there for 2 years. It probably has not gone up in value much. In fact, it may have been bought at a very high price, but you've got deferred gain against it. And now you sell it and all of a sudden you have a gain. You can use your $500,000 exclusion against that. And again, you basically bury or eliminate some of the gain from the fire proceeds on the original real property. So it's complicated. It can be costly in tax initially, but it can have a good outcome at the end.
And, to me, this is just one of the perfect examples of don't worry about the tax situation. If this is quality of life and you've made a decision that it makes more sense now to move into this home and you will sell it in the future, it's where you have to continually look at the big picture. And if taxes hit, taxes will hit. Do what's right for you and your family based on quality of life decisions.
Yeah, I totally agree with you, Eileen. The one thing that in that particular instance is the taxpayer used all of the funds for the down payment, so they didn't think that they were going to have to pay taxes on the remainder of that 150,000. So it was like, where did they come up with the money to pay the tax on that? So they should have only used maybe 100,000 or 115,000 of the money and set aside the remaining to pay the taxes.
As I said, it's big picture going in and being aware of your choices.
Right.
Ask the questions before larger financial decisions are made. There's various buckets that are going to come into play, and you have to be careful on picking and choosing them.
Exactly.
All right. So I've got on the screen just the do I need professional help? This has got some resources for you. Recapping, failure to report a casualty event on a tax return could lead to an audit. Time limits are important. Make sure you file for your extension. You do have to file. If you are, if you're not on our website, if you haven't been to our website, not getting our emails, please be sure to sign up. Survivor forums coming up. It's a great source of information from people who've been there as well. Let's see, upcoming events here. So these are different workshops coming up. Please take advantage of any of these free resources. Again, just thank you for joining us today. Here's again where to sign up. If you've got any specific insurance issues that you need help with the Department of Insurance, this is how to get in contact with them. Please take advantage of that. Let me see what else we've got. Thank you to our funders. Without them, we wouldn't be able to do this work, so we greatly appreciate their support. In case you haven't seen it, very important, this is a short survey we're doing at the 6-month mark. This is so important to what we do on the back end. So this program is the roadmap to recovery, and this is where we're working through the nuts and bolts of helping you with your insurance and recovery related issues. We take that information, and then we have a program called Advocacy in Action, that where we take what we find that you're experiencing and we're able to improve the situation for future survivors. So Prop 19 is an example of identifying a need and flagging that to the attention to get that passed. The 36 months people have with a catastrophic federally declared disaster in the state of California is a direct result of what happened in the 2017 Tubbs fire survivors. 24 months was not enough, and so they took the information from our survey and survivors, and they went and pushed the legislature to fix that issue, and they did. So wanted to make sure I highlight this survey. And then that is the end of the slide deck. And I know we are at the just a hair over the hour. I do have, I want to thank both of you for participating. I've got 4 questions. If John, actually they just keep popping up here. We don't have a lot of time, but let me run. So ALE is paying us rent for us to live in our second home because the primary residence burned down. Is that ALE taxable? It would be just like they're paying it to a landlord. And
Yeah, so in effect, yeah, the rent, exactly, it basically is taxable. Yeah.
okay, because they're collecting, if they were paying that money to a different landlord, it wouldn't be taxable by them, it would be taxable by the other landlord. Okay.
Right. But in this case, it's basically supporting their cost of holding that home.
All right. And then if the destroyed home is a second home, can you just recap very concisely what that looks like? What the difference in the rules are?
Well, first of all, the contents have to be accounted for separately from real property, and the calculations have to be done on the contents, just like they have to be done on the real property. The Section 121 $500,000 exclusion does not exist for that, and the replacement period is reduced from that 4-year period down to 2-year period after the first year in which you first realize a gain.
All right. And then 2 more, and I'm not even sure I'm going to read this right, so bear with me. If there's a loan over the basis, which is paid off from the insurance proceeds, is there a tax due on the loan over the basis? And the qualifiers, if the entire proceeds were used to replace that rental?
Well, the payoff of a loan is not a tax event.
Got it. All right. And then last question. This is someone who's done their own taxes every year, and so he was told by the IRS he can claim some 2018 disaster losses on his 2017 return, and the question is simply what tax forms and supplemental documents does he need to submit to the IRS and the franchise tax board?
First comment is I want to say that it's very possible that a tax professional, CPA, an enrolled agent, could get through a whole career without having one client that has one of these events. I know of about 20 CPAs that this is their only, they have one client that has one of these events, and this is probably the only time that they'll have that in their whole career. So given the lack of expertise that happens as a result of that on the profession side, the same thing happens on the IRS side, okay? And so they're flying blind quite a bit in terms of the individual people inside the IRS. They're not to say that there aren't people in there that are very smart. There are extremely there are people that are very dedicated that have a lot of experience, but they're not dealing with it on the field. So I would strongly recommend not trying to do this on your own. Find an accountant to help you.
All right, now thank you for that. And just to remind everyone on, we will provide the slides for this, and not typical for our events. We actually recorded this Q&A. So if you missed anything, like your question getting answered, that recording will be available to you as well. So John, so following up on the basis, you said the payoff of the loan is not a taxable event. The question is whether that's true if the loan is over the basis, and is it ordinary income?
No. It's, I mean, it's just not, paying off the loan is not a taxable event, period.
Got it. All right, and that is it. Thank you both for your time, and I appreciate you giving us much more time. Thank you all for joining, and Carolyn, you can stop recording now, and we will get off of here in just a second. Thank you both for your time today. So much appreciated.
Very welcome.
Very welcome. Take